there's the types of financing structures, and then there's the way that capital is deployed. Within the financing structures, you mentioned a number of them, but there's sort of 4 categories we look at, which is still the use of traditional equity and debt, but thinking a little bit differently about how that equity and debt is used. There's a redesigned risk capital, which is really thinking about things like structured exits, redeemable equity, which we can share an example of preferred stock, revenue-based mezz debt. I already talked about revenue-based financing, things like a demand dividend. The third category is non-dilutive or grant funding. So looking at things like PRIs, looking at redeemable, recoverable grants, forgivable loans, convertible grants, and other types of innovative grant financing. There's tons of great examples out there of the way that grant funders have used their funding creatively. And then fourth category within sort of the financing structures being impact-linked finance, as I already mentioned, social impact bonds and outcome-based financing, social impact incentives, which are a little bit more of a simplified version, and the interest rate rebate that I mentioned. And then there's the category of funding approaches, which is how capital is deployed. Many of you are probably very, very familiar with crowdfunding as an alternative way for folks to raise capital. I mentioned Village Capital's approach, which is really about a peer decision-making and peer due diligence decision-making process, or a community-led capital process. And then there was also, as a company gets further along, you brought up the point about ownership, the idea of creating a structure in which a company can become a worker-owned, employee-owned cooperative. And there's some really exciting funds that are emerging that are focused on helping companies convert to employee ownership. So lots of exciting things going on there. But Nathaly, if you want to jump in and share a little bit more on a specific example.
Yeah, I think I would maybe also add supply chain financing. That's one that doesn't always come to mind for folks, but that could be an option, depending on the stage of the company and if it even makes sense, if it's, you're selling a tangible product or not. But I guess maybe one that could be of interest is redeemable equity. So expanding on that one a tiny bit, it's essentially, and I highly recommend Capital Explorer, self-promo there, but also the Innovative Finance Playbook, which is a brilliant resource to learn more about these structures. But essentially, it's providing risk capital. So it's a structure that can be used for pre-revenue companies as well as those already generating revenue, but more towards the earlier stages. And how it works is that the investor provides an investment into the company, and the entrepreneur or the founders have the option to repurchase part or all of the shares that were sold from that investor. And so that usually is there's a lot of different ways you can structure it, but how it tends to work is that the company will say, receive $100,000 investment, and then the startup will have the option to repay or repurchase those shares using a percentage of their revenues over a set period of time until they pay back a specific amount or a multiple of the original investment. And so say if the investment was 100,000 and the multiple is a 2x multiple, well, then the company will have to repurchase their shares at 200,000 using a percentage of their revenues over a set period of time. Now, what's interesting about this structure is, again, that provides that optionality. So particularly at the pre-revenue stage, if the company needs risk capital but isn't entirely clear around what that growth path will be, or even do they want to exit the company in the future? Do they not? Do they want to retain ownership? It provides that optionality to say, hey, I'm receiving the risk capital, investing in the business, starting to grow, and if I happen to want to continue down the venture path, then you can do that, and the investment continues like logging in as equity. And if not, then you can go and repurchase those shares and retain ownership, and therefore kind of reduces that pressure to go round after round after round, and prioritizes more of this value over valuation. So those are a few, I highly recommend taking a look at the examples, and also just the information that the Innovative Finance Playbook provides on redeemable equity. It's super useful.